how to combine with a principal and divergence part 5. In this video tutorial, I will explain to traders the different types of divergences that appear during the fifth Elliott wave. The fifth Elliott wave is the last Elliott wave of the motive wave of the trending phase of the Elliott wave cycle. The Elliott wave cycle is formed of the motive wave and the corrective phase. Alright? As a divergence trader, one should be able to filter out false divergences. If one is combining the wave principle or the wave theory with a divergence trading, one is likely to make better divergence trading decisions. Alright, so during the fifth Elliott wave, what are we looking for? Alright, so I will explain to traders exactly what they need to do. Alright. So the first thing that we want to use is the Fibonacci retracement tool. We want to apply the Fibonacci retracement, okay, to the third Elliott wave. Okay, so here we are. I have my Fibonacci tool. We want to apply. Now, let me correct myself. We will apply Fibonacci extensions. So this is a correction. We will not apply Fibonacci retracement, but we will instead apply Fibonacci extensions to the third Elliott wave. All right, so let's apply the Fibonacci extensions to the third Elliott wave. And the level that I want trader to highlight is the 138.2% Fibonacci extension level of the third Elliott wave. Very often, valid high probability divergence trading setups will appear on or near the 138.2% Fibonacci extension level of the third Elliott wave. So my green horizontal line here is the 138.2% Fibonacci extension level of my third Elliott wave. You can see that drawn line here: first wave, second wave, third wave, fourth wave. And now I apply Fibonacci extensions to my third Elliott wave, and the green horizontal line is highlighting the 138.2% Fibonacci extension level. Talking about how to combine wave principle and divergence trading, we want to highlight the 138.2% Fibonacci extension level of the third Elliott wave. Very often, valid or high probability bullish or bearish trade setup will appear at 138.2% Fibonacci extension level of the third Elliott wave. Here it is. All right? Now, does it mean that when we see, okay, for instance, in an uptrend, a bearish divergence at 138.2% Fibonacci extension level of the third Elliott wave, we can just sell? Or does it mean that when we see a bullish divergence at 138.2% Fibonacci extension level, okay, of a bearish third Elliott wave, should we buy straight away? No. We will apply a top-down trading method or a multiple time frame trading method to trade it. We'll also combine the technical analysis with the fundamentals. So what we can do is that we highlight that level and monitor the reaction of the price. If, on the other hand, the price breaks above that level of 1.3, even if we see a bearish divergence here, okay, but the price still breaks above that level and find the support, we will not sell. We will buy instead because we are trading the price itself. If you were in a downtrend, okay, and then we highlight the 138.2% Fibonacci extension level of the third bearish wave in a downtrend, we will highlight it, but if the price D below that level and find a resistance, we will sell instead, though we have noticed a bullish divergence. The divergences are also only warning. We will trade the price itself, okay? So remember the 138.2% Fibonacci extension level. So what usually takes place, trader will use a scanning software or screening software to detect, okay, divergence trading setups, okay? So you have your list of divergence stock, or yourself, you go through stock manually and you have noticed divergence stock, you have your list, okay? Now you want to filter out false divergences. If you combine divergence trading strategy with the wave principle, and you have noticed that, okay, there is some of the stocks that are displaying or exhibiting divergences in the zone of 138.2% Fibonacci extension level of the third Elliott wave, you'll give them more consideration without ignoring the market pattern and the market environment and the fundamental. Ultimately, you will use the top-down trading method to trade, okay, those setup. Okay? So remember that level during the fifth Elliott wave. The next thing that we can do is to use the length. Okay, so this is the length of the first Elliott wave. All right. So according to the Elliott wave, okay, strategies, all right, if the third Elliott wave is prolonged, is extended, is dynamic, is very, very strong, there is usually what we call equality between the first and the fifth wave, which means either in length or in magnitude. So talking about the length is from here to here, that's my first wave. So we will project, okay? So you see this is the beginning of the fifth wave. So I'm talking about my wave count, first wave, second wave, third wave, fourth wave, and the orange line here, that's my fifth wave. So we will measure the length of the first wave if the third Elliott wave, okay, is extended. There is a high chance that the length of the first wave will be equal to the length of the fifth wave. So we want to highlight that level. So we put it here, that's the length of the first wave. If the third Elliott wave is extended, we highlight that level. So if we see, for instance, in this zone, bullish or bearish divergence, we will also give them a consideration using a top-down trading method, okay? These are trading setup, not trading signal. We want to pay attention to the economy news and also the market environment and the economy news, okay? But if we see a bearish divergence here, but the price breaks above that level and finds support, we will buy instead because it's going up and we are trading the price safe. The first, the third, and the fifth wave can be extended. So bear that in mind that the fifth wave can be extended like the third and the first one. So if you highlight these levels that I'm talking to you now, do not just jump and sell and forget, but be aware that the fifth wave can be extended. Okay, so two levels, the 138.2% Fibonacci extension level of the third Elliott wave. We want to watch that level. Okay, we want to also watch where there is equality between the first and the fifth wave. Now, I recommend to trader to use also the magnitude of the first wave. This is the magnitude of the first wave, the height. The price went up from A to B. So we are talking about the height. So it went up from, if this is the length from here all the way up here, that's the length. The magnitude is from one horizontal line from the low to the high. So this is the magnitude of the first wave. So we can also use that. And we want to highlight, okay, so here it must like this, okay? And we highlight that level. If we see an Elliott wave failure, if you don't know what is an Elliott wave failure, okay, check 24 Elliott wave YouTube channel. The Elliott wave failure will take place when the high of the fifth wave is lower than the high of the third Elliott wave. So if we use the magnitude of the first wave, we highlight that level, and we see a divergence in that zone, we will also give a consideration to that divergence. As always, we'll use a top-down trading method. This is the trading setup on a higher time frame. We go to the signal time frame, and then we select a low-risk entry point. We don't want to violate the market pattern or repeat any of the 7 biggest trading mistakes. By the way, if you want to know about the 7 biggest trading mistakes, go to dayprotraders.com. Okay? We don't want to violate the market pattern. We want to pay attention to the market environment, and we are also paying attention to the high impact economy news. So these are the 3 levels that we can watch during the 5th wave to highlight, possible, reversal zone, which will be, confirmed by either a bullish or a bearish divergence during the 5th wave. I want to clarify with traders that the best divergence can also take place during the 5th wave, as we have told traders already that the best divergence will take place at the end of the 2nd wave, when we are ready to buy or we are ready to catch the 3rd Elliott wave. All right? So watch part 2, so you want to understand how to identify the valid or the best bullish and bearish divergence. Watch part 2 of this series of videos. We also see valid divergences during the 5th Elliott wave because the motive wave is about to end. So first wave, 2nd wave, 3rd wave, 4th wave, 5th wave, all together will form what we call the motive wave. It's the trending phase of an Elliott wave cycle. But there is something else that I want you to be aware of, talking about the divergences that appear during the 5th wave. I explained to you already in part 4 that when the 4th corrective wave, the 4th Elliott wave, is prolonged, all right, for a long time, talking about the time it took for the 4th wave to be completed. If it takes it too long to be completed, there is a high chance that the 5th wave will be extended. If you want to know more about the 5th wave extensions, go to www.24elliottwaves.com to learn to master the 5th Elliott wave extensions. All right, so in the case of the 5th wave extensions, we are likely to see what? Forced divergences. So by analyzing the 4th Elliott wave, we can also forecast whether we're going to have the 5th wave extension. So if you are already aware that the 5th wave will be extended, one example is this. If the 1st wave is not extended, the 3rd Elliott wave is not extended, there's a high chance that the 5th wave will be extended. Let me say this again. If the 1st wave is not extended, the 3rd wave is not extended, there's a high chance that the 5th wave will be extended. Okay? If the 4th wave is prolonged, there's a high chance that the 5th wave will be extended. Check our webpage at 24elliottwaves.com to know more about the 5th wave extensions. All right? So if you already know that the 5th wave is likely to be extended, any divergence that we may see during that extension are false divergences. It's great to know, isn't it? It's great to know. That's why I love Elliott wave, because sometimes you see a divergence trading setup, then you combine the divergence trading with the Elliott wave, and then you notice that this is a useless, a divergence trade setup, and you don't want to waste your time to trade it at all. It's great to know, all right? If you were not aware of it, you will trade it, and maybe you get into trouble or waste your time trading it. But everything that we are discussing here, my friend, is a bit exciting, and I don't want you to use it as a science. It's not an exact science. These are guidelines that we use to navigate through the market. So we are aware of something, we know something, we have an edge, all right? But we don't jump ahead, okay? So when we see it, we smile, but then we allow the price to show us what is taking place. And when it's taking place, my friend, you don't need permission, you take advantage of it, okay? But the mistake that a lot of Elliott wave traders are making is that they know it, they are arrogant, okay? They insult other traders, and they jump into the trade, and other traders mess up their trade for them. Or you don't want to ignore other market participants just because you are an experienced Elliott wave traders. Okay, the timing is very important, and the 6 biggest trading mistakes, we don't want to repeat any of them at all. All right, it makes sense? So the divergences that we see during a extended 5th Elliott wave are usually useless. Okay, but if the 5th Elliott wave is extended, okay, so it's subdivided into 5 waves, which we can forecast sometime. All right, so if we can forecast it, we know that, okay, 5th wave is likely to be extended. Market environment is great. But remember, one thing I need to clarify. Suppose the 1st wave is not extended, okay? The 3rd wave is not extended. So according to the Elliott wave rule, we'll expect the 5th wave to be extended. But remember, before the 5th wave can be extended, we must have some fundamentals supporting the extension. So be aware of that. So don't use that information, okay, alone, combining with the fundamental, okay? It makes sense. It makes sense, all right? Otherwise, if you work for a hedge fund managers, they will look at you like you're a mad trader, okay? Fundamental counts, okay? Say that, fundamental counts. The old way of using technical alone is a madness, okay? You can quote me on that. This is to make you laugh a bit. But it's just to highlight why it's so important to pay attention to the fundamental and to combine it with the technical. It makes sense, it's beautiful, and when both align, all right, you will enjoy the trade, okay? You will enjoy the trade. Recently, as you see, the market was expecting, okay, the interest rate to go up in the United States, and we see a lot of consolidation in the financial market. Suppose you were not aware of any of this, and you were living on your own technical island somewhere doing your own thing, you can quickly get into trouble, all right? So very, very important, okay? Let's move on. So, to summarize the video, we are highlighting the 138.2% Fibonacci extension of the 3rd Elliott wave. There's a high chance we may see valid, bullish, and bearish divergence in that zone. We can also use the length and the magnitude of the 1st Elliott wave projected at the beginning of the 5th wave to highlight possible, okay, reversal zone that will be confirmed by, okay, bullish or bearish divergence, okay? If the 5th wave is extended, we are likely to see false divergences during the 5th wave. The only divergence that we can trade during the extended 5th wave is the one that we see at the end of the extended 5th wave. Okay? All right, so the 5th wave is now completed, the extended 5th wave is completed. We see 1, 2, 3, 4, 5 is clearly completed. We will check the fundamental market environment. Now we draw. We don't want to violate the market pattern. The trend line will help us make better decisions. Trend line is kaput, break below, retest. All right, top-down trading method, okay, without assuming anything, without jumping ahead of the market. All right. So end of the extended 5th wave, we are likely to see another valid, okay, divergence, a trading setup. There are more to this. We can also use, as I explained to you, okay, before, wave genius, the projection of the consolidation at the before the 1st wave breakout. Projection, we keep projecting that the width of the consolidation here, that we want to watch each point. So if we end here, we highlight that level all the way up, all the way up. So if we see a divergence somewhere here at one of those levels, we'll also give consideration to, okay, that divergence, okay, during the 5th Elliott wave, the projection of the width of the consolidation before the breakout. We can also use, is it getting too much for you? You can also use the magnitude of the 1st wave. So you see here, this is the magnitude of the 1st wave. So we put, you see that's the high here. So I project it here above the high of the 1st wave. And then I keep doing that like this. Okay, and then I keep moving it. All right, until we reach the 5th wave. So I want to watch this level also. If I see bullish, bearish divergence in that zone, okay, I will also give a consideration to that. I would like to recommend to traders videos that are posted at 24 Elliott Wave YouTube channel about how to forecast the 5th Elliott Wave. Okay, with that information, you can also position yourself to take advantage of the best divergences that are taking place on near, okay, the end of the 5th wave that we have already forecast. This is the end of this series of video about how to combine the wave principle and divergence, part 1 to 5. In part 1, we were talking about divergences that are appearing during the first wave, all right? There are temporary divergences during the first wave, and there are also false divergences during the first Elliott wave. We move on to the second part. We were talking about divergences that appear in the second wave. Then we move to the third Elliott wave, the fourth wave. Now we are discussing divergences that are taking place during the 5th wave. I will be recording another series of videos when I will be talking about divergences that are appearing during the corrective phase. So what do I mean by that? We have the motive wave, 1, 2, 3, 4, 5 wave, followed by A, B, C. This is what we call the corrective phase of an Elliott wave cycle. So I will be recording another series of videos when I will be talking about divergences that will appear during the corrective phase, part 1, part 2, part 3. Alright? So if you like this video, please give us the thumbs up. But if you dislike it, we want to know, give us the thumbs down, alright? And if you love this video, feel free to share it on Google+, on Twitter, and also on Scoop.it or whatever, okay? But if you love our videos, alright, feel free to subscribe to our channel. We will be recording more tutorials like this, and to share every secret that we have about the wave trading. I would like to thank traders, okay, for their time, for their support, for watching our video, all right? And we wish you the very best in your trading. Until the next time, enjoy yourself and be very happy. We are the TSTW 24 traders talking about how to combine wave principle and divergence part 5. End of this series of video. Speak to you soon.